Hello, and welcome everyone to the webinar. I'm Abhijit Awasthi, and I'm going to be the moderator for this session. And in this session, we are going to talk about multiple things related to markets, but primarily about tariffs and its impact on global economy and markets. And to discuss the same, we have two very esteemed personalities from the market domain. Firstly, Mr. Sameer Narang, Head of Economic Research Group, ICICI Bank, and along with him, Mr. Pankaj Pandey, Head of Research, ICICI Securities. Welcome, Sameer. Welcome, Pankaj. Thanks for joining us. Hi. So we'll start now. Sameer, my first question comes to you. And before moving on to the topic of tariff, we'll deviate a little bit and talk about something which is very pertinent and very headline grabbing right now, which is the recent spate of increased hostilities in Middle East. Do you think that this will have a long-term impact in terms of slowing down of global growth or increase in overall inflation, primarily through the increase in oil prices? And a small follow-up on that bit. Do you think that there will be a set of economies and countries which will gain out of this chaos, and there will be a set of countries which will be on the losing side? What do you think?
Thank you so much, Abhijit. First of all, a very warm welcome to all the participants and people who've taken out time to listen to this. Thank you so much for giving us this, opportunity and privilege. And now coming to your, question on the Iran-Israel conflict, which has, somehow overtaken the narrative of tariffs, and that's why perhaps you're asking this before we move on to the topic of today, which is tariff. No, you're right. Actually, on a more immediate basis, this is a big concern. And we've seen that, why it is important is the fact that earlier we also had a conflict in Europe, which is the Russia-Ukraine war, which was supposed to last a few days, but lasted fairly long. And given those uncertainties, it becomes more pertinent to, discuss this event today than any time else. But, first of all, there's always good and bad. So the good thing is that, the world is less dependent on fossil fuels than it was a decade back or 2 decades back. Now the world is increasingly moving to renewables. And that, helps at the margin that all economies are increasingly gearing their investments not in fossils, not in petroleum, but on renewables. And to that extent, it acts as an accelerator, or it gives you more incentive to do this at an even faster pace. So to that extent, it's accelerates it, and it to some extent is positive for world growth. But at the same time, given that still a large amount of world economy is reliant on fossil fuels, be it coal for generating power or diesel and ATF and petrol for transportation of goods, people through air, as well as mobility for people. There will be an impact on different economies. If you are an oil producing country, you are better off because you'll get a higher realization. So you'll have ability to spend more on in your economy through infrastructure or any other means that you would like to. But if you're an oil consuming country like India, you will be impacted. At the same time, currencies will react accordingly. If you're an oil consuming country like India, you've seen a little bit of depreciation. Other oil consuming countries would as well. And oil producing countries ideally should see an appreciation bias to the extent that the currencies are floating. A number of these oil producing countries also have fixed exchange rates pegged to the dollar. So the impact would vary. But at the margin, the good news is that the world is increasingly moving towards fossil fuels. So to that extent, it insulates the world from an investment standpoint. But the estimates largely suggest that for every $10 increase in oil prices, world GDP growth on an average slows down by 0.2 to 0.3%. This drag will be visible this year and next year as well, as the world adjusts over a period of time. Naturally, the consuming countries will be hit more than the producing countries, but it also is important that how long this war lasts or prices last. If prices remain around current level, I think already the world growth was marked down because of higher tariffs. So you may not see any large substantial decrease in the current estimates, maybe another 10 basis points, because prices at the beginning of the year were also very similar to current levels. In between, they had gone down to $65 a barrel and now back at 75. The good news is that prices have not gone all the way to 80 or 90 or 100, as we saw at the time of the Russia-Ukraine war, which had a much larger impact on world inflation. Typically, at that point in time, the world was coming out of the pandemic. Central banks had a very, very expansionary fiscal monetary policies, and governments had very expansionary fiscal policies that led to a very large increase in inflation across the world, and the central banks had to respond accordingly. Good news is that you are not in that segment now. At the same time, yes, it will be inflationary. Again, the estimates suggest that inflation goes up by around 40 basis points. So world growth is lower by around 20 basis points. Inflation is twice of that. It goes up. It hurts, consuming countries more than producer countries. And it also depends what the governments do. Some of the governments typically absorb this in their own, fiscal. So they cut back on other spending, they cut back on capex, they cut back on welfare spending. So it all depends on different economies, but on an average, the impact would be largely, in this magnitude. Now, the other part is uh, why have the oil prices not gone up to that extent, given that Iran is an important producer country. It produces around about 3.5 million barrels on a daily basis, which is around 3.5% of world oil supply and demand. But its exports are only 1.5% of world supply at around about 1.4, 1.5 million barrels, mostly consumed by China. Now, the good news is that OPEC has 5.4 million barrels of excess capacity, which it can, plug it out from its wells and supply to the world market. So that is why oil prices have not gone up. Oil markets were largely in surplus of 1.5, 1.6 million barrels in the last 2 months. So that surplus has gone away. Oil prices have adjusted back up. Now, the problem is that if the container traffic from the Strait of Hormuz is impacted, then prices will go up even further. And if the war lasts for longer, costs will go up because already insurance costs or freight costs are going up for any ship that passes through the Strait of Hormuz. For the benefit of our viewers, Strait of Hormuz, approximately 20% of global oil passes through the Strait of Hormuz. So what happens to the strait determines the future of oil prices. Last time when the strait was partially shut was 1972. And during that time, again, there were a multitude of conflicts happening with Israel, amongst other Arab countries, and there was an embargo placed on by OPEC on supplying oil to many Western countries, and that led to the first oil price shock. So hopefully, we are not in that political environment today. So the crisis ideally should not last that long. It should get over much sooner. But the longer it lasts, the deeper the impact. Now, winners and losers coming to India from that standpoint. Well, India's current account deficit expands. For every $10 increase in oil, the current account deficit ideally goes up by 0.3% of GDP. That also has an impact on the currency. As you know, the currency has depreciated since this crisis began because India imports approximately 85% to 90% of its oil, requirements. And these requirements are growing by 3 to 4%. It would have grown even faster had it not been the transition to renewables within India as well. So India is also like world markets transitioning to renewables. India added approximately 30 gigawatt of capacity last year. The plan is to add approximately 50 gigawatt of renewable capacity in the next few years, every year. So that way, to that extent, it may accelerate renewables investments in India as well. But in the near term, it will definitely have an impact on inflation, which is also likely to go up. If the prices are passed through to the consumer, then you can have 35 basis points of cumulative impact, both direct and indirect. And at the same time, if their prices are not passed, a part of it is absorbed by the government. For every $10, approximately, 0.2 to 0.3% of, fiscal hit is there. So these are the, policy choices which the government has, either to pass it to the consumer or absorb it itself. If it absorbs it itself, then, it sacrifices that kind of revenue that it would have gotten otherwise, or it would have to cut its spending from somewhere else if it is not raising prices. Notably, we were thinking that the government would raise, excise duty to get extra revenues when oil prices had come to 65, but that window of opportunity has gone as of now. So incrementally, government spending would be lower than what we would have thought otherwise, but it's pretty much in line with the budget. So it doesn't impact India to that extent because, as I said, beginning of the year, oil prices were any which is around $75 a barrel. So India's current pump prices are oriented towards that number. If oil prices go up by another $5 to $10 a barrel, that is when the hit to the economy starts. As of now, I think in fairly neutral territory, it doesn't impact us much. And hopefully the conflict doesn't last very long. It gets over soon so that we are back to doing, leading a normal life where only the tariffs matter. Thank you. Over to you.
Yeah, thanks, Samir. So as I understand that though the crisis is there, but the impact on the overall markets is not will not be as brutal as it was, as you suggested. That was the case in 1972 when we said that there was a oil price shock and all, because economies also have graduated towards a more renewable kind of setup. Uh, Now, Pankaj, my question to you would be on the same topic, but with a slightly different flavor. Uh, I wanted to ask that given these geopolitical tensions which are emanating from everywhere, recently in Middle East, and but prior to that also in Russia, Ukraine, and in the Indian-Pakistan border also. So, do you think that increasing spends on defense space is the way forward? And how do you find opportunities in this space? And if there are opportunities, whether there are multiple micro sub segments also to look out for?
So, Abhijit, as we speak, we are already seeing defense spending going up. In fact, according to one study, defense spending in 2024 witnessed an appreciation of nearly 9.5%, and which is the steepest rise we have seen since 1988. And we've seen big economies like, say, US, Russia, China, Germany, including India. So all of them have been increasing their defense spending. And I think overall sense is that this kind of a geopolitical issues, what it is going on in terms of Russia, Ukraine, or Israel with Gaza and Iran, I think all that is going to further drive the overall defense spending. Now, Europe, for example, a region used to spend about 2% odd. Now they are looking to sort of spend the 3.5%, largely because probably the protection from NATO may not be there. Then the other thing is that in India, we are spending about 1.9% of the overall GDP in defense. Recently, the defense secretary highlighted that it could eventually in future go up to 2.5%. Now, when you sort of translate something like this into numbers, it's about $100 billion kind of a capex in the next 5 years. And the defense in India has already been sort of doing very well. Just to sort of give you context, from April lows, we have seen Nifty, which is a key benchmark index, up about 15 odd %. And defense as a segment or a sector is up about 85%. So it's already doing well. Overall, in domestically, defense has already been sort of witnessing good amount of traction. And just to sort of highlight, a period between say 2013 to 2022, the acceptance of necessity was given to nearly about $100 billion worth kind of a projects. This is a stage prior to the ordering and tendering. So typically it takes 3 years to acceptance of necessity to sort of get converted into orders. Now, last 10 years, which is 2013 to 22, we have seen about $100 billion. But what has happened is that in last 3 years, we have given acceptance of necessity to nearly $110 or $115 billion worth of projects. And so, which is why defense as a segment in India has been sort of doing very well. And I'm not really surprised with the kind of 80% kind of a rally what we have seen. But having said that, this 80% plus rally is capturing most of the near-term positives because most of the stocks are trading on a forward basis at 50 times. So wouldn't sort of suggest to sort of take exposure at current levels, but any good correction would create a good opportunity, or in case someone has a very longish view, that is when only can sort of consider. But I think consolidation or correction is something one needs to wait for.
And Pankaj, any sub-segments in the overall defense segment, any sub-segment which you would be interested in and would like our viewers to be aware of?
So one is, I think overall sense is that India is expected to become or is looking to sort of position itself as a key manufacturing partner. And I think overall this global conflict, what is going on is positioning India in a pretty positive context. And also in the recent India-Pakistan conflict, also Indian defense platforms, including missiles, UAVs, munitions, they have already proved their capabilities. And in fact, the defense minister is also sort of highlighting that going forward, indigenization, innovation, and global leadership is what they are looking at. And it's not only this industry is going to cater to the domestic requirements, but we are also looking at being manufacturing partners and also looking export as an opportunity. So what we like in what I like in terms of segment is again fighter aircraft as a category, warships, submarines, and electronics is something which we are liking besides UAVs.
Thanks, Pankaj. Thanks. So we'll move on now. We'll move on to the topic of the or the agenda item for this webinar today, which is the tariffs. My question to you, Samir, would be that post the chaos which we saw after the Liberation Day announcements, and then a cool down period where some of it was postponed. Now again, we are close to the 9 July deadline. Do you see that whatever has happened in the intervening period, would you see that US would now soften its stance, and and if they soften or they don't soften, how would it impact either the US economy or the global economy and the Indian economy per se?
No, so you're right, Abhijit. There's been a lot of back and forth on the tariffs. As you can see, initially we were looking at, it started with the reciprocal tariffs, which was 26% on India, somewhere in mid-40s for other Asian manufacturing countries, and it went all the way till 145% for China. Then tariffs were brought down to 10% for most of the countries, apart from China, which is on a higher tariff. And then you have Canada and Mexico, which are on a slightly different, tariff regime. In between, we've had a situation in which the US and China have had some negotiations. There's a lot of back and forth there as well. As you can see, it started with a meeting in Geneva, which went to London. China imposed a ban on rare earth exports, which hurt global, auto value chains. And then they both sat on a negotiating table in which US initially said that they will not allow Chinese to study in the US. So then, they came out an agreement that China will send, or rather export its rare earth minerals for a period of 6 months, and US will allow Chinese students to study perhaps for a semester, which is ongoing right now. So 6 months down the line, I think we'll again hear on these negotiations in between something moves or not. But in general, what we have seen is that the movement on tariffs has not been, or the movement towards negotiating a deal apart from the US-UK deal has not moved to that extent. And I think it's in line with your questioning as well, that your first question that you asked was in Middle East rather than tariffs, because a lot of political capital or discussions have moved to Israel, Iran, Israel, in terms of both European, Middle Eastern, as well as the US. The effort of the top leadership is on how to figure out to get the conflict over, or what is the end game there. So to that extent, tariffs have taken a back seat. But whatever movement that we've seen over the last couple of weeks, we have seen that the US, UK have signed a deal. Most of the elements suggest that you have 10% baseline tariff. You will have areas where US will get certain preferential access, and certain areas where the other partner will get certain preferential access. But US-UK deal as such is not that significant because UK runs a trade deficit with US. So, you are looking at striking deals with countries which run upwards of $200 billion, surplus with America. And that is very complex, and at the same time, if we do understand, the president is also, trying to achieve multiple objectives with the tariffs. One is baseline tariff 10% suggests that the US is looking at somewhere between $200 to $300 billion of extra revenue. And when fiscal deficits are high, it's a good proposition, and they are looking at another tax bill which will perhaps give more deductions to taxpayers than before, and so more revenue the better. Second is reshoring manufacturing jobs back into America. That is the second objective. The third is to cut the trade deficit as such, and make America great again by prospering its manufacturing. And we've seen that in case of steel and aluminum, tariffs have been revised all the way to 100%. So in a nutshell, I think there are multiple issues that the president is trying to achieve, and tariffs are serving into some of these perennial issues that American politics has been facing. Particularly, manufacturing jobs not moving back to America. What is likely to happen, given the pace of negotiations is not very fast, perhaps is the fact that a baseline tariff of 10% for friendly countries, maybe slightly higher for countries which are linked to the Chinese value chain like Vietnam, Malaysia, and a few others, and then even higher tariff for China. At the same time, we should not forget that there is the tax bill, the big and beautiful tax bill that is lying with the Senate today, and it is about to be passed with certain modifications, as it was passed by the House already, in which there is Section 899 provision in which the American government can charge tax to any country which runs a very large trade surplus with America, or any entity. So the limited point being that the negotiations are not only on tariffs. America has opened up another gamut over here by extending the Section 899, or opening up the Section 899 into its tax bill, by which it can tax any foreign any entity based in a foreign country. It could be any corporate entity, which can be taxed at a much higher rate than it is being taxed today. And I think the American politics did a very similar thing a long time back, perhaps 100 years back, to again extract concessions from its trading partners, and it was successful then. And that is why it has been brought to the table. Now, coming to, in case of India, what does it mean for India, India's economy? Well, India also runs a trade surplus, but only 40 odd billion dollars, between 40 and $45 billion. And the good news is that once the reciprocal tariffs have been announced, India's exports to US are rising in mid-teens. So India has done much better than the rest of the world. And that is because of electronics value chain, Apple, iPhone exports that are happening from India into America. Now, India produces approximately 1/5 of all iPhones in the world. So India has gained share in the last couple of years. Indian government also has been putting a lot of emphasis on manufacturing, as Pankaj spoke about, and electronics is one of the key areas where the government has given a production-linked incentive scheme. It is very, very successful. Uh, the other part, which is doing very well because of India's integration in global value chains, is the services exports led by GCCs. A lot of commercial real estate in India is expanding because of a lot of services moving away from other parts of the world into India, be it design, be it software, be it accounting, HR. A lot of work of high value addition happens out of India today than it happens anywhere else in the world. It is also driving India's growth higher. Services exports in India, net services exports are around 15 to 16 odd billion dollars now. And that's, that tells you the fact that it is doing phenomenally well compared to what it was perhaps 5 or 10 years back. So I think in a scope of around about 10 years, this number has tripled from where it was. And remittances also that India gets from both from Middle East as well as America have been doing fairly well. This number has doubled in the course of a decade. So India benefits a lot from its services, from its remittances, and its reliance on goods exports is any which way is limited, particularly the US as well. India's exports to the US as a percentage of GDP is only around 2%. So to that extent, hit on India is limited. But we do feel our view is that India will be a net beneficiary. It was a net beneficiary in Trump 1.0 as well. It will be a bigger beneficiary in Trump 2.0, as we can see in the case of electronics and iPhones. It's just the beginning. And you will see incrementally more and more, trade relationship between India and US, not only centered around services and goods, but also in terms of foreign investments, FDI flows, FPI flows from America into India can also go up. America notably is the third largest investor into India in terms of FDI. This number can actually go to number 1 or number 2 in the next 5 years, given the fact that growth within India is also picking up, coming from a cyclical slowdown, and government is taking a lot of steps. RBI has cut rates by 100 basis points. All of that put together, along with a good monsoon and rural growth, implies that India should grow closer to last year's number, and then gradually growth picks up. So in a nutshell, to summarize, India is insulated because it's reliant on exports. It's a very domestic-driven economy. Services are a equally important component in terms of his exports than goods to America. And from an India-America standpoint, given the relationship that is progressing on electronics and some of the other segments like defense, technology sharing, implies that, ideally India will be a beneficiary of the current tariff turmoil like Trump 1.0. We believe it will be a bigger beneficiary this time around because India is also far more better prepared. And it's signing FTAs not only with the US, but Europe. It has also signed an FTA with UK, Australia, UAE, and other FTAs are in progress. So I think exports will become an important part of India's growth strategy, given that it stands as an alternative to China.
Thanks, Abir. So overall, even this tariff chaos, India will come out as a net beneficiary compared to some of its peers, where they'll end up losing slightly bit more. So, Pankaj, my question to you would be that are there any specific industries which will get impacted by these tariff negotiations, both on the positive or on the negative side, howsoever the final tariff agreement shapes up?
So, Abhijit, as we speak, we still don't have enough clarity on eventually how the tariffs will sort of pan out. So there are a lot of still unknowns. But having said that, we are already seeing some impact. So, for example, IT is one of the biggest services exporter, and this sector is already facing headwinds largely because of the potential client level budget cuts. And I think US is already witnessing inflationary pressure, and also there is a possibility of lower economic growth there. So IT is one sector which is clearly sort of witnessing the impact. I think further impact can be very much possible because, for example, if the equipment cost goes up because of tariff, then a lot of these transformational projects which Indian IT companies undertake could witness margin pressure. And I think overall sense what you get is that for IT, any kind of improvement is expected 1 year down the line. This year looks like more of a washout. So IT is clearly sort of witnessing the impact. Now, pharma is another sector where our sense is that, if you look at it from a number perspective, we export somewhere about $9 billion, and in terms of imports from US is at about $800 million. And overall, India contributes nearly 40% of the generic volumes in the US. And overall sense is that any kind of a tariff, if it gets levied, especially on the generic side, I think India will have not much of an option but to sort of pass on this cost, because the cost of producing a generic medicine in India versus US is quite cheaper. So in US, the cost is upwards of 5 to 6x of what it can happen in India. But this segment is already witnessing a lot of competitive pressure. So margins are already under sort of strain for most of the players. So any kind of incremental increase because of tariff will be passed on. So we would not really see much of an impact because besides India, China is on the other option. But given the way global supply chains are getting rewired, I don't think China is going to be a big beneficiary. So here, India is expected to be at a relative advantage situation. And auto is another sector where we can sort of look at it this into two parts. One is the OEMs. So typically we are not a big exporter of cars or SUVs or any kind of automobile product, but auto ancillary side we do export a decent amount. So from that perspective, overall sense is that we could witness some pressure directly in terms of the cost going up, and also because of an indirect impact of the US economy witnessing slower growth and that impacting the overall demand. So we do exports of forging components, then engine components, tires, and a lot of other auto equipment. So from that perspective, auto could get impacted. And metal again is another sector where we feel that the impact is going to be minimal, because whatever India exports, especially in terms of ferrous products, steel, the export to US is about 2% odd, whereas for aluminium it's slightly higher at about 10% odd. I think for metal, the bigger worry is what happens in terms of tariff with relations to China, because China has been sort of pushing a lot of these ferrous and non-ferrous materials outside, and that has sort of depressed the prices to at a 4 or a 5 year low. And that has a universal impact across all the sectors. Now, textile is one sector which we clearly feel is going to be a beneficiary, like Samir highlighted. It is possible that the tariff on China and Chinese value chain countries, say for example Vietnam, could be higher. Now, for textiles, China, Vietnam, and Bangladesh are the top 3 textile exporters. Now, overall sense is that China, in India, you will see a lower levy of about 25, 26% in terms of reciprocal tariff. Eventually, the final tariff we still don't know. But I think overall sense is that the tariff on the relative countries is going to be a lot more higher. So China overall sense is that it would be about 54%. It could be about 46% on Vietnam. Bangladesh would be about 37%. So on a relative basis, we will at be at a slight advantage. And I think India also holds a good amount of advantage, especially in cotton-based textiles, given the fact that we grow a lot of cotton domestically. So from that perspective, I think textile is something which we feel is going to be a beneficiary going forward. And I think overall on the gems and jewelry, again, there could be some slight benefit if it happens. But overall, the other sector where we feel that there could be a slight advantage is again capital goods space. So we've got companies in the industrial product side, bearings, solar modules, so where we have got a fairly decent exposure. Here again, compared to China, India is at a slight advantage because the overall tariff for solar equipment is lower compared to China, which stands at about 50 odd percent. So as long as the relative tariff arbitrage remains, I think Indian capital goods companies, especially the solar power or module manufacturers, are expected to benefit. But like I said, all these are sort of evolving situations sectorally, so we can't really say for sure. But positionally, our sense is that we will see some sectors getting impacted. But like Samir highlighted, we are not a major exporter. So on a relative basis, we are at a far more better position compared to a lot of economies which are dominated or which largely do a lot of exports. So we are quite resilient from that perspective. Over to you.
Thanks, Pankaj. So you spoke about multiple sectors: IT, pharma, auto, metal, textiles, capital goods. So the general feeling which I get from what you said is that apart from IT, which is seeing a generalized slowdown because of the customer requirements getting curtailed, other sectors are relatively in a better shape because other export powerhouse nations will get impacted more by higher tariffs vis-a-vis India, and we now actually have a chance to increase our share in the overall export basket to US. So that might be true now, given that the
Absolutely.
countries like the countries like
Absolutely. Absolutely.
Vietnam, yeah. Samir, my next question to you would be on uh, the Fed, and we just had the Fed meeting this week. We all remember a time like last year prior to Trump getting the nomination and Trump getting on the presidential scene, that central bank watching used to be the only game in the town. But now, with all these geopolitical tensions and geopolitical events taking the highlight, that has taken a slight sheen off from the Fed and the other central banks. But still, it remains an important parameter for anyone who is going to decide their investment strategy. So in this recent Fed meeting, it looked like that they are still very cautious about committing anything on the cut side because they are still thinking about the impact on inflation of all these tariffs, and they seemed slightly hawkish. So do you think that the rates in US will remain elevated for long? And what is your thought about the terminal rates which we will see in US?
Well, I think yes. So the Fed has been, impacted, or its decision making has been impacted by the tariffs and the prospects of higher inflation. Uh, Despite growth deaccelerating over the last few weeks or months, particularly once these tariffs have been, brought to the table, we are seeing the American economy getting impacted, sentiment indicators getting impacted. Even the gains in employment have come down. The economy was slowing down any which ways, and this perhaps has added a little bit more uncertainty along with other policies on immigration, and has made Fed's task very difficult because on a forward-looking basis, inflation is likely to go up. The broader forecast that Fed also has given in its latest meeting is that inflation is likely to go up from the current level to almost around 3% by the end of this year, and then closer to 2.4, 2.5% next year. On growth, while forecasts have been reduced, because inflation is expected to go up, it is helped the Fed's hand in terms of moving on interest rates. Because you're right, the real rates today are very high. So inflation is around 2.3, 2.4%, and interest rates are around 4 to 4.5. So you have a real rate of around 2%. But if you take inflation all the way to 3% or slightly higher than that by the end of the year, then the real rate is around 1/4 to 1.5%. So on a forward-looking basis, real rates are not as high as what they are. And so they are impacting the sentiment and growth right now. Does it mean the Fed will not cut? No, I think the Fed will, or perhaps they will be in a position to cut once they have slight more certainty on tariffs, which perhaps can happen as early as next month. If it doesn't happen, they'll have a much better idea as to, sorry, where the tariffs are likely to settle. As we discussed, 10% for most economies, maybe 15 to 20% for others. It's slightly higher for China. On a weighted average basis, that number should be around 15 to 20%, which will be around 10, 12% higher than what the tariffs were earlier. So that leads to, the inflation shock that we are talking about around, inflation settling at around 3% by the end of the year, because services inflation in America is falling today because of lack of demand or lower demand, particularly for housing and for other, services. So that's good news. And that implies that the Fed will be in a position to cut rates by the end of the year. Now, your question was on terminal rate. What will be their terminal rate? That will also be determined by fiscal policy. America is running a deficit of around 6% of GDP in the foreseeable future if the current tax bill is passed. And that implies issuances will be very high at a time where the many central banks are not willing to buy US Treasury and US assets, given the uncertainty on tariffs and Section 899 provisions. So that implies that there will be fewer buyers, more issuances, and yields ideally remain higher in this kind of construct, unless and until you make yourself much more attractive through your policies for foreign money to flow in. You will see a situation in which interest rates, because of these demand-supply dynamics, remain slightly on the higher side. And that implies that, the Fed may not be able to bring the terminal rate to as low as, it would have liked otherwise. So even in the current construct, what we are seeing from the Fed side, at least the dot plots that they've indicated, they are saying that they will do fewer rate cuts next year and the year after that, and perhaps do 50 basis points this year. But the economy perhaps will not evolve as per the current information. If tariffs remain where they are, sentiment is where it is, you should see the economy deaccelerating. And the good news is that services inflation is deaccelerating. So it should give Fed room to cut rates eventually. But the terminal rate may perhaps settle around 3.5%, or may not go below 3%, at least, even if the economy deteriorates much more than that. And what that implies is that the 10-year for the US is around 4.4%. It goes down in case of a 100 basis point kind of rate cut, but may not go point to point. So the short end of the curve goes down. The long end remains slightly elevated. It does maybe half of what the short end would do. And in that case, 10-year rates actually settle at a higher pace than they would have otherwise in a normal economy. What does it mean for the world? Well, most of the world is actually seeing a deflationary or a disinflationary shock because of the tariffs, where demand compression is going to be visible from the export side. In India's case, also inflation has hit a 7-year low, 2.8%. This year, it is likely to be below target. That is why RBI has been front-loading cut rates by 100 basis points. ECB has cut by 200 basis points. PBOC has cut rates. Everybody has cut rates simply because of the fact that they wanted to spur growth when external uncertainty is at very high levels. And that is what has triggered most of the central banks to ease. Fed is slightly behind other central banks because of the policy choices being taken over there in terms of tariffs, which will push inflation higher. unlike most of the world where inflation is coming down and gives room for the central banks to cut rates. And that is how IT gets positioned. But higher interest rates in America over the long run have implications for other countries as well. India, which is a mild current account deficit country, will also face an issue in terms of how low interest rates can go, how much the central bank can cut, given that you are a current account deficit country. So to that extent, if interest rate differentials at a historical level have to be maintained, then the Indian central bank also has limited room to cut rates to support growth going forward. And that will have a bearing for most of the other emerging market central banks, because if the dollar interest rates remain high, there is only that much of room that is there to bring local interest rates lower, particularly in countries which have current account deficits. So globally, it will create some pressure on central banks to cut rates beyond a point, but then fiscal policy may be at play going forward. But those are things which will have to be evaluated at a later point in time. Over to you.
Samir, just a follow-up there. The terminal rate question which I asked, I understand that it will get very much impacted by who comes on in the Fed chair role uh, come next year, when Powell has to move out and the next person who is going to be appointed by the current administration, and then how much will they be willing to the line of the government? Will that be a major factor of how the terminal rate decision follows up?
You see, whenever you're a new person, you can have a little bit of leg room, or you can push the stress, the rubber band a little bit more. But ultimately, it's a job which is oriented by its own mandate. The mandate is maximum employment and stable inflation, bringing it to target of 2%. If the inflation is much above target, and the central bank has any which way lost credibility when it thought that inflation was transitory last time around, and till now inflation has not come down to target. So it's a very long period of a miss that Fed has seen in the last 50 years. Last time around, they missed these targets was in 1970s, which had its own problems. Again, driven by very high fiscal deficits post I think, the Vietnam War. The US had very high fiscal deficits. It continued for a period of time. Under Richard Nixon, they went out of the gold standard. And then Volcker had to come after Arthur Burns. And he had to raise rates all the way to 20% to bring down inflation, because inflation expectations had got anchored at a very high level. So I think there is some leg room. Could be 25, 50 extra than you would have liked otherwise. But then it ends there, because once the Fed loses its credibility, then you'll have bigger problems for the dollar index and for the bond market. Now let's take a step back and see what happened in the case of England. There also they tried to increase fiscal deficit to spur spending, to spur growth, and bond yields went up. And in case of America as well, the moment markets felt that the policy is going out of hand, bond yields went up, and the president had to actually do back and forth on tariffs. So I think ultimately the bond markets will decide how much legroom is there. Perhaps you're right, there is still a bit of legroom, but it gets limited beyond a point, given that 1/3 of America's debt is owned by foreigners, and they would also have a say as to what will happen to the future of the Fed in terms of interest rates.
Thanks, Samir. Pankaj, to you, I would like to ask that, as Samir said, that there is a possibility that the Fed rates would remain elevated and they might not come down quickly on the trajectory per se. So, do you see that such kind of differential, the interest rate differential between India and US would ultimately impact the Indian equity markets also, apart from the bond markets?
So, Abhijit, I think, see, like Samir highlighted, see, we are already seeing a big amount of divergence between the inflation trends in the US and in India. So, like you said, inflation in India is at about 6 or 7 year lows. In last 6 months, inflation has come down by half. Now, higher inflation is not a good scenario for a country like US because it overall impacts the overall consumption. And we are already seeing impact, especially for a sector like technology. The discretionary spends have taken a backseat. In addition to that, if the inflation remains high and the interest rate remain high, then it is very much possible that other sectors, like, say, for example, I spoke about textile, auto ancillary products, or even some of the other products the demand might get impacted. So that is where the export-oriented segments of the economy might get impacted. But Abhijit, we are largely a domestic-driven economy, and in fact, I would want to believe that if US does not do economically so well because of the higher interest rate, it is actually beneficial for emerging markets. And the reason why I say so is that US market up till now has been the beneficiary, and which is why people have been saying that the US, since it commands 70% of the overall market share, market cap, any crisis happens and the US market used to do well because the money used to sort of flow to US. Now, if US is not doing well, I would want to believe that a lot of money which is sort of waiting on the sidelines may not really sort of go to US, and as depicted in the dollar index as well. So actually, it could flow back to some of the emerging markets, and India is one of the emerging markets where the growth rate is one of the highest. So I would want to believe that the foreign portfolio flows in India could actually pick up, or India could be beneficiary of those flows. So that is positive. And something similar also can happen on the debt side, because on the fiscal deficit side, our fiscal deficit is very well contained. And so both inflows on the debt and equity is actually very beneficial for any economy, because what it does is that it lowers the cost of capital, and eventually that again increases the risk appetite of businesses. So I would want to believe that for a country like India, it's going to be positive. But yes, we still need to see how sort of things evolve. But while export-oriented sectors or segments might get impacted, including IT, because IT is obviously a major exporter. But since our economy is mostly domestic-driven, I would want to believe that the inflows, both in equity and also in the debt side, could be a structural positive which could unfold.
Thanks, Pankaj. So that's an interesting point, Pankaj, that if the rates remain high in US and the economy is slightly seeing a slight slowdown, then the capital which is sitting on sidelines will come to emerging markets, and countries like India will be the beneficiary. So that's an interesting point. I'll move to the last question for the session. Samir, my question to you would be on the Indian rupee. How do you see the Indian rupee performing in the coming days? And given that there has been huge volatility in the dollar index, do you see that it will be governed more by the dollar index performance or by the domestic consideration, including RBI?
No, I think very interesting. So what we've seen that the rupee is coming out of a period of very low volatility. It's much more driven by market conditions today than it was earlier. What you see right now is an era in which the dollar index, as you correctly pointed out, is sliding lower. It's volatile, but largely the direction has been lower. Why? Because of lower growth. That's a cyclical issue in case of the dollar. And the other issue is that the foreigners don't want to own US assets to that extent because of the tariff issues and Section 899 provisions and other, host of other factors. So central banks are not buying US treasuries to that extent or anymore. It's flat pretty much. At the same time, there are other, entities globally which have still bought approximately 1 trillion worth of US assets, US debt, which are non-sovereign entities. So overall, 1/3 of US debt is owned by foreigners, and The problem is that if the inflows actually deaccelerate or dip, as Pankaj is talking about, then the dollar actually comes under even more pressure. So you have a period of low growth, high fiscal deficits, and if fund flows are not, matching to the extent that the fiscal deficit should be funded, then demand for dollar assets is lower, idle interest rates remain high, and also the fact that the dollar is sliding lower. But as of now, what we have seen is that mostly it's the developed market currencies like Euro, GBP, JPY, Swiss franc, which have done much better. The emerging market currencies have gained somewhere around 5 to 7% at best. China, I think, is around 2%. India is actually slightly lower because of the recent, oil prices increase. Prior to that, it was, I think, up around 1%. So what has happened is that most of the gains are based out of or are concentrated in the developed market currencies, and emerging market currencies have not gained to that extent right now. Will it change for the rupee? The good news is that it's not overvalued anymore. It's fairly valued. If other emerging currencies do appreciate, there is some limited scope for appreciation. But the bigger worry for India has been that capital inflows and in general have not been that high as you've seen in earlier cycles. So they're yet to pick up. And a buoyant equity market is also ensuring that a lot of outflows are there from the FDI repatriation. Outward FDI has also picked up as Indian companies are absorbing assets outside. So all of that put together ensured that the net capital inflows into India are, not that large. And that's not very, positive for a currency that needs to appreciate. At the same time, RBI, as part of its operations, is running very large forward short positions. Once they also have to be, neutralized, for which RBI perhaps would absorb whatever inflows will come. And that will also imply that the rupee may not appreciate to that extent. Apart from that, what Pankaj spoke about, that India wants to be a manufacturing hub. So currency becomes an important, tool of ensuring that you are competitive. So you would want a currency which is competitive. So you don't want currency which appreciates against its peers beyond a point. So a little bit of mild appreciation bias is possible, but we will not put it in a camp that there'll be a large appreciation that is likely to happen. So a move closer to 85 over the next 6 months is possible, but that is also contingent upon what happens in Iran. If the conflict gets over into 3-4 weeks, then perhaps things are looking good. Inflows into EMs pick up. All EM currencies appreciate. INR also appreciates a tad bit, but maintains its valuation against its peers so that it's competitive. And that's the broader direction, which the RBI would also be happy to pursue exports, services exports, and goods exports, which India is, really looking forward to gaining share in because of the fact that the goods exports as a percent of GDP are not to the Asian, economy level. So that is how ideally it all ties up. But if geopolitical concerns pick up, then the INR has room to depreciate, given that, as we explained in the first question, that we are a oil-consuming country. Every $10 increase leads to an expansion of CAD, which is negative for the INR, in which case it depreciates.
Thanks, Abhi. Thanks for giving us the insight that. And as I take the answer from you, that rupee looks slightly on the appreciating path from here, which is currently at around 86.5. Given all these combinations do add up, then we'll see it around 85.5 in next few days. Obviously, all the reasons for it to depreciate are also there, given this Middle East conflict not getting prolonged. Pankaj, my question to you is one which we have received from one of our clients, and he wants to know that what are the major sectors that will take lead in the stock market in the next 5 years, 3 to 5 years time frame.
So, Abhijit, I think if I sort of see last 10, 15 odd years, I think capital expenditure by the central government has been the hallmark of policy. At this point in time, we are spending about 3% of the overall GDP on capital expenditure. And I think recent comment suggests that we are likely to sort of maintain this kind of a level. So capital expenditure beneficiaries, be it capital goods, cement, infra, and associated segments, I think this is a segment which looks attractive from a next 3 to 5 year perspective. Then I think what we are clearly seeing in a big sector like power, given the need for more of renewable energy and less of hydrocarbon usage, I think power is witnessing a transition, and power not only globally but domestically also, like Samir also highlighted that overall progressively we are going to add more of renewable energy, and which is why power is a core sector which is going to sort of do very well in the next 3 to 5 years. The one more sector I would want to highlight is the banking and financial services. Every 5 or 8 odd years, we used to have this asset quality concerns coming up because the NPA cycle used to happen, or the asset sort of turns bad and the banks had to do heavy provisioning. But what we are clearly seeing is the change in borrower behavior. So from that perspective, borrower behavior has definitely changed. Promoters are quite fearful of not losing control over the company. So banking and financial services as a segment is witnessing a structural transformation. I think that it's a basic change or a fundamental change what we are seeing in a big sector like BFSI. And banking and financial services extremely important. It's one third of the overall Nifty as an index. So that is one. Then I think consumption in India is also sort of doing well, but selective pockets. So, for example, in auto, SUV as a segment is doing well, and within that, the SUVs which are getting preferred is again automatic vehicles, then alloy wheels, or a technology-oriented product like ADAS Level 2, which is a one step below automatic braking or autonomous braking. Then hotels and hospitals are another segment where clearly the demand supply is quite sort of imbalanced at this point in time, and demand is expected to be there over the next 3 to 5 years. So we like that space. And I think real estate also is a beneficiary of this upturn in consumption, especially the premium leg of the real estate market. So I think premiumization on the consumption is going to benefit some of the segments or sub-segments which I spoke about.
Thanks, Pankaj. So I'll, in the interest of time, one last question from the customer side, which we have to take, and that comes to you, Samir. What are your quick thoughts about future of gold, given all the uncertainty and volatility?
Future of growth, you said, right?
Not growth, gold as an
Gold.
asset
Oh,
class.
okay. No, so gold, interesting. So I think all these uncertainties, as you pointed out, Pankaj has pointed out, we've discussed in the webinar today, has led to central banks not buying dollar assets, but buying more of gold. So I think last year they bought a record 1,000 tons of gold. The last few years, actually, that's been happening. That from 400, 500 tons, that's moved to almost double of that to around 1,000 tons. And this perhaps will continue as a trend. And that has led to a structural change in demand supply balance. So more demand from central banks is driving prices of gold higher. Then you have, demand for consumption from jewelry, which is fairly stable over the last couple of years. But it's not gone down despite prices where they are. So that tells you that the underlying demand supply conditions are very favorable. And this perhaps leads to a situation in which gold prices continue to go up or remain elevated. The corrections that we see are fairly mild. Historically, also, gold prices do come down, but not by much, and then they have potential to go up by 80 to 100% in the cycle. By the way, we already doubled from the bottom of the previous cycle, which was around 1,650 to $700 an ounce, and we are closer to 3,400 now. And given the construct, it's possible the uncertainty on the dollar index and on dollar assets, that it has potential to go up even more from here before it starts retreating once the macroeconomic backdrop is more favorable for other assets compared to gold. So it has potential to go up even more. Largely, it's structural because of demand supply dynamics being very favorable, led by buying central banks.
Thanks, Samir. So with this, we come to the end of this webinar, and thanks, Samir, thanks, Pankaj, a lot for
Thank you.
this wonderful and insightful session. I'm very confident that our audience, our customers, our clients who have joined in the webinar would have taken a lot of notes and would use those notes to take a very informed call on their investments going forward. Thanks again for joining in. And one small request to all the audience who has tuned in, that there will be a feedback pop-up on your screen. Please do give us your comments and your feedback so that we can improve for the next time. Thanks everyone. Thanks for joining in. Thank you.
Thank you so much.